All right, so let's get into the numbers. We got a lot of stuff to walk through, and then we'll get into valuation, which I know is a big topic of discussion. But numbers were nothing short of incredible. I mean, we got these numbers on Monday, and I don't think anyone expected them to be this good. There was so much hoopla about Palantir not releasing any PRs in January, and people were like, why are they so quiet? That's because they were closing deals, and they really didn't have to show off their deals because the numbers do the talking. U.S. revenue, 52% year over year. Commercial revenue, 64%. Government revenue in the U.S., 45%. Top line revenue, 36%. 14% quarter over quarter, $828 million. We are getting very close to Palantir putting up billion-dollar revenue quarters, which is incredible. They closed about 129 deals of at least $1 million, record-setting $803 million in U.S. commercial total contract value. Customer count was up 43% year over year, 13% quarter over quarter, which actually increased from the decline we saw last quarter when it went up only 6% compared to 7% from 2 quarters before. So that was a dramatic increase as well. GAAP net income, $79 million. It would have been 165 if not for the SARS expense. So the SARS stuff we were talking about, it ended up being a concern, but not enough because their margins were good enough to still produce enough of a profit to not be able to miss on EPS. Rule of 40, 81%. Karp made a joke about how Rule of 40 should be called Rule of 80 now because Palantir is changing the game when it comes to Rule of 40s. And then they have $5.2 billion in cash, no debt. For 2025, they are guiding for 31% growth and revenue of 3.7 to 3.75 billion. For Q1, they're expecting 858 to 862 million and about 2 billion of adjusted free cash flow towards the end of 2025. We'll talk about if we think they're sandbagging and what those projections ultimately look like. The headline of this quarter was Palantir reports Q4 2024 revenue growth of 36% year over year, 52% in the United States, issues full year 2025 guidance of 31%, eviscerating consensus estimates. The fact that Palantir put that in the title is just, it's cool, right? They're doing it their way and they really don't care about what anyone has to say. Real quick, the quote from Karp at the beginning of the PR. Our business results continue to astound, demonstrating our deepening position at the center of the AI revolution. Our early insights surrounding the commoditization of LLMs have evolved from theory to fact. I would also like to congratulate Palantirians for their extraordinary contributions to our growth. They have earned every bit of the company's or of the compensation from the delivery of their market vesting stock appreciation rights, aka SARS, which ended up not being a concern in terms of the stock's reaction. Let's start with you, Arnie. Your reaction to the numbers and any specific metrics that you want to go over.
I insisted a lot, actually for quite some time, about this concept of the Rule of 40, when people were not still really considering Palantir as a SaaS component, as a SaaS company. As a matter of fact, Bessemer, who has this fancy website with all the SaaS companies ranked, digested in all possible metrics, actually was not considering Palantir at all. Maybe still doesn't because it seems they hate them. But when we actually compare Palantir, what it is doing compared with all the rest of the industry, we notice something very peculiar, something that we started to underscore already months ago, that while the industry was still in a trouble after a very, very prolonged, they had a peak in 2020, 2021 when money was easy and people were just spending too much on software. But then the period of rationality, the period of efficiency, like all these startups that and software companies that went too fat just to grow, realized, okay, we actually need to deliver profits. So you see the SaaS industry, this is for until June, but the trend actually is exactly the same in the updated numbers. We're just, okay, the revenue growth is slowing down, the margins are going up, but that came exactly with a sort of a sacrifice. You can't really grow more if you spend less, if your business works linearly. But wait a second, Palantir actually did that, and it did it in the most beautiful way. Essentially, since the launch of AIP, it disrupted its own business model. That was due mainly with bootcamps, but that also helped all the motion, all the network effects to actually start to trigger. And what we are seeing here is literally the definition of black magic. Palantir raised the revenue growth from around 15% to 35%, even more if we exclude the SPACs. And meanwhile, expanding the margins to a level that is frankly obscene, with 45% or more or less free cash flow margin, which means Palantir is not only growing very fast, essentially faster than all the other SaaS companies of similar size, but doing that while also printing money. That's the definition of black magic, which I think is the underlying pillars with which we should now consider the valuation, because without understanding these, all the valuation talks are just useless. I had the honor to help Only CFO, who has a very good newsletter on SaaS, explaining, okay, this dynamics really matters, and if you understand this dynamic, you realize how analysts made essentially the same mistakes that they were making when they were analyzing Palantir in 2022, essentially expecting Palantir to just grow 20% while having margins that were still low. Actually, we saw this dynamic, but multiplied by a factor of 10.
I don't even think it was that. I think it was the fact that back in 2022, they were like, oh, this company doesn't even make money. When you clearly look at the adjusted cash flow, they were adding cash to the balance sheet. And it was like just complete nonsense why people weren't thinking about it back then. But the thing that, sorry, I know I'm just jumping in here, but the thing that I think made me most inspired was actually going back to the Friday before. So I guess literally a week ago when Amir said, I think we'll get to, I think he said it was like 11 or something % year or quarter over quarter growth. And I said, Amir, you're smoking some crazy European stuff over there, because we haven't seen that since, I don't know, it was like the third quarter or fourth quarter of 2021. And here we are, 14% quarter over quarter. Like, how insane is that? That wasn't just that matching what showed up in 2021 or 2022 as the quarter over quarter growth. It surpassed it by literally a huge margin. And to see that, in one single quarter, that massive jump was insane. I think what it was I think Amir was projecting 800 million. And I was like, that's 75 million than last quarter. That's insane. It's literally 10%. And what we showed up with was 14% quarter over quarter. Absolutely insanity.
Yeah, I think relating to that, the most important aspect is actually how well they are monetizing the current clients. The 20% out of the 36 actually came from existing clients, which is why it's so important. I mean, one of the main concerns that I had was the slowdown in the customer account growth going into this quarter, because customers are the core driver of that scaling mechanism that Palantir has. And I was really glad to see that customer account growth accelerate like massively, like all-time high net additions of customers, like a real acceleration. Because as you just mentioned, it's hard to imagine new clients contributing that amount of growth. Like, you need the current clients to actually keep scaling up, keep spending more. And that's what we're starting to see. And I mean, as Arnie mentioned, after the launch of AIP, at the end of Q1, it took about to Q2 or Q3. No matter what metric you pull up for Palantir, if you chart out this KPI or that KPI, this growth rate, this growth, everything pivots as soon as AIP launched. Like, you will see it on every chart. At Q3 or Q2 or Q3 of 2023, everything just starts going up and to the right. Like, it's really magical how boot camps that go to market change everything. And we're seeing, like, I've looked at a lot of businesses. I've probably never seen, if we're talking quality of growth, like, a lot of businesses can grow a lot, but growing a lot while also massively improving margins, very, very rare. And I think that's one of the reasons that a lot of people are getting excited to own Palantir. So quality of growth can commonly be measured with the rule of 40, as we talked about. And yeah, score of 81 is just absolutely, like, as Carp says, it's almost unheard of. Like, it is completely crazy. But also like sales efficiency, like customer acquisition costs all-time low, time to pay back that customer acquisition costs all-time low. Like it's just such a pivotal quarter. And when I look at like, okay, is this growth sustainable? Will the growth slow down? And when we look at the contract balances, they are at all-time high, like total contract value, remaining deal value, RPO, everything is just at all-time highs. There's not really anything that is suggesting that Palantir will slow down growth. And we talked about it like, okay, the stock price, pretty elevated. What does Palantir need to do in order to keep the momentum? And yeah, just keep accelerating. And from the numbers itself, I'm not really seeing anything that's suggesting that they won't keep accelerating from here. So it's really, as Arnie mentioned, like black magic just to see how important that AIP launch was and the bootcamp go-to-market strategy, because it's just so efficient in terms of sales and it's just so high quality in terms of growth. So even looking if we exclude SPACs and just look at organic growth, they grew 39% year over year and over 30% for 3 quarters in a row already. Like people are talking like, yeah, I want to see Palantir grow at 30%. Like they've been doing that for 3 quarters. If you just exclude SPACs, which is inorganic, like the actual core business for Palantir has been growing at that rate for quite a while now. So it's just a magical quarter in terms of the actual numbers. There is only like the only thing that I can find that is a concern to me still is in international. Corp addressed it on the earnings call, and if you go back from the very first earnings call, I've said this a bunch of times, so I'm like a broken record. Since the first earnings call, he has nagged on Europe. The management has been critical of Europe and that Europe is not adapting. In about 80% of all the earnings calls Palantir has ever had, they have been criticizing Europe. And I don't know when that change is going to come. For now, the US has plenty of growth for Palantir. Like Europe is not such a concern at this stage. It might even be years before we actually need to see meaningful contribution from Europe. But yeah, it's been flat for very long time. So if you are to point out like one single thing that's not amazing, it would be international growth, and mainly that's due to Europe. So outside of that, everything is just fantastic, like honestly fantastic.
Yeah, I agree. Arnie, go ahead.
No, it's not that international is not really growing, but is really growing at a disappointing rate compared with what it could potentially be, especially on the commercial side. Because on the government side, we talked about the expansions, for instance, in the UK, which is going very well. I know something good is going to arrive in terms of deepening into the understanding there. But for instance, you can see here in the commercial, like the difference between international commercial clients and revenues. You see the revenues are more or less stuck, but at least we're getting many customers in terms of international commerce. But look, compare this that we are seeing right now on the screen with US commercial. Like it's literally black and white. Yeah. You see both their revenues and the commercial clients expanding. And what's really staggering is realizing, wait a second, yes, the commercial revenues are growing very, very fast, now above 50% for many quarters. But look at the growth of clients. Here we are talking of big clients that haven't fully scaled yet. So this is the intuition that we discussed many times here at Palantir Weekly. So kudos to us that, hey, wait a second. If the number of customers, especially in the US commercial, which is the most lucrative market, is growing way faster than the revenues, it only means it is a matter of time before we will see that dynamic also becoming revenues. Because when you start dealing with Palantir, you don't buy a subscription that you pay that amount for the rest of your life. You tend to start slow, to acquire the client, they need to start relatively small, tackling a critical issue. But then as confidence builds up, you can spend more. The more use cases you solve, the more you realize, oh shit, like I can deploy this not only to this department, to these use cases, I can deploy this full scale across my enterprise. And that's where the real magic happens. So until we see these US commercial clients growing and growing very healthily, we know there is all this future substance in terms of revenues that is going to come.
Yeah, I think there's two things here, and then I'll give it to Matt and see what numbers he liked the most from earnings. Number one, as Connor says right in their chat, Palantir hasn't even gone down market yet, right? And so we have 700 customers. One day we're going to have thousands and thousands of customers, and probably those thousands are going to also come from going down market. So when that happens, that's going to be a game changer. Number two, in terms of international revenues, like what is Germany going to do for the next 10 years? Are they just not going to grow? Are we going to have GDP at 0%? Negative, like is that actually, because if that's not going to happen and we assume that Europe actually gets their shit together, that's going to be a tailwind for Palantir. And if it's going to be a tailwind for Palantir, or at least tech companies in general that are creating some level of transformation in the enterprise on that continent, you would imagine there's a handful of them that are actually going to catch that bid. And if one of them ends up being Palantir, that's something the analysts definitely haven't thought about. And when we see that inflection point, that might also be very exciting when it comes to growth long term.
You know, ironically, the forecast for the European area economic growth is actually 0%. They came in at 0.8 last year, and it's projected to slow down even further. So, unironically, like it's that bad, and they will have to wake up. I think, like. All credit to the 47th president. I think he's doing a great job cleaning up and exposing some of the inner workings. And I think that might start to come and affect Europe. I know Italy, that Arne is from, is doing some like major criticism towards how things are going. I think that's spreading. So sooner or later, I do hope that we get a reinvigorated Europe that actually makes away with like attaching bottle caps to the bottle and like these stupid things, these massive regulations of everything, and actually like starts to foster some real growth and some real innovation again, as they have been historically. So that time might be coming. I wouldn't count on it too soon though.
Look, consider that we have been not growing for so long that it's like when you buy a company and it just goes down or stays flat forever, like ask Baba investors. Like you start losing hope. And once you start losing hope, as a company, as a country, it is really hard to make that motion again. It's still possible, but you need to be really inspired, to be very united into, okay, we are going to change how things work. And the very cool thing is Italy, but Europe in general, I think we are not stupid, but we lack that emotional confidence into we can make it. That is actually very strong in the US. And typically, if we see the US makes it right, initially we are not, but then when you realize, okay, it's a matter of survival for your own stake, okay, let's move on. Let's try to do something. So I think that's the play also Palantir is making. Okay, rather than trying to beg these European companies, please adopt Palantir. You actually need this to become competitive or to stay competitive in the marketplace. Okay, we will show you how people that really care about investing in innovation do. And as Karp always says, we don't need to convince you. We provide you the evidence, you convince yourself. I think that's the reason why it's like, okay, I tried my best to try to trigger you, not really working. We will focus on into companies that really care of investing in this stuff because this stuff works. And once you will see it works, then you will convince yourself.
Yeah, I agree. And someone says, Amit, would it make sense for NATO to be on the same military platform as the US? Do you think that's a possibility? I think a lot of the NATO countries are in play to catch a bid, or for Palantir to catch a bid from them, especially with increased defense spending. I think the Pentagon announced today, or Trump, or one of the people in that inner circle said that military spending is up another 150 billion this year, something along that line, or over the next couple of years, which means there's going to be more money spent on defense. And Trump wants, as per his Davos speech, NATO countries to spend about 5% of their GDP on defense. And so if that happens, you would imagine Palantir gets some leverage there. One final stat from my side is operating margins. I thought this was exceptional, dude. 38% last quarter to 45%. I mean, what do you say? 7% quarter over quarter. If that can get to 50 to 55%, even if top line growth is not 40, 45%, we are going to see a lot more net income and earnings growth on Palantir by just them being more efficient and doing this with less than 4,000 employees.
Yeah, I think this is one of the major. Oh, sorry. Go ahead, Matt. I saw.
No, it's okay. Just didn't want to interrupt you guys. The thing that I was most excited about was comparable to what Amit just pointed out, which is the cash flow margin. I think that continues to be something that cycles between like mid 20s and now 50 something % plus that we've seen in this quarter. So it just goes to show how much of a cash engine this thing can really be. And, you know, it depends. We're always going to have the issue with share-based compensation. Google has it. Many other companies have it. You know, it's not something that's going to go away. But with such a nice, I guess, cash flow contribution every single month or every single quarter, you could utilize that to offset that. And then not only that, but then some, invest into other things like Shield AI and things of the like. So to me, while I've been critical about the share-based compensation, the dilution, things of the like, I do want to see that capital frame be shifted more towards the SPACs investment. I think it was still, while I recognize where people may have thought that the SPAC investments in 2021 were a mistake, I'm more on the lines of if they just adjusted it to be more of like in line with 10% or 15% of cash to the balance sheet, I don't think they would have gotten themselves in as much trouble. And so I think that if they do continue to do something like that, now that we're going to be throwing off over $1 billion a year in cash to the balance sheet, you know, using 150, 200 million of that on an annual basis to invest in innovative things that could grow, like Waymo and Wejo, like all those things that showed up that were really not Waymo, I meant Wejo, and many of the other things that like Lilium and many other companies that they invested in, Black Sky, etc. It allows them to get a head start on these innovative solutions and come up with more long-term software things like Warp Speed, right? And to me, that's where the moat is going into the future, is understanding what the software solution is for AI, understanding what the software solution is for electric cars or automated cars, understanding what the solution is for a lot of different industries, and then figuring out if you can package it. To be honest, I'm surprised they haven't fully unleashed a software specifically for healthcare. While I know that they have many of the beds in the United States, I'm surprised they don't have something like Health AI or something like that they've branded, kind of like what they've done with Warp Speed. Maybe they're perfecting it. Maybe people want to do their own, what's the word I'm saying, disparate solution at each hospital. Who knows what specifically and what reason, but I'm surprised I haven't packaged that up, knowing that they already support probably at this point over a quarter of the beds in the nation, at least in the US.
Yeah, I can share just quickly about the dilution that is becoming less and less of an issue, actually. This is the outstanding expenses related to, now we don't have the final Q4 numbers yet. The 10K is not out. Come on, Palantir, put out the 10K. But if you look annually at outstanding SPC expenses, it's been going down. Now, of course, we don't have like these are the same, but I expect that to keep going down. And that can also be seen if you look at SPC. Now, of course, we got the SARS expense here, but as a percentage of revenue, we were down to like 19, 20-ish per quarter, which actually, if you compare to the whole SaaS world, Palantir is actually giving out less SPC on a percentage basis than the average. I made the calculation that including like 15 to 20 SaaS businesses, the average is actually somewhere around 24% of revenue goes towards SPC, and Palantir has been at 20. It's going down. Like if we look at the outstanding expenses, it's also been going down. Now, of course, they can issue new packages and stuff, which we saw in 2024. But like on an overall basis, it's really going down percentage-wise now. Of course, the SARS skewed all of that for this particular instance, but it's not as bad as people make it out to be. If you recall, going back like even a couple of quarters or even a year, all the craze was about, oh my God, Palantir's dilution. It's so crazy. They are SBC up the wazoo. And I'm like, it's not actually as bad as you might think. Now, 20%, of course, high, but within the industry, they're actually below the average. I think the best ones are very old businesses like an Oracle, for example. But if you look at these like similarly growing businesses, like ServiceNow is the best at like 14-15%. And if Palantir can get to that 15%, I would think that that's all right. And I think it's headed that way within the next couple of years.
I was curious, who else is in the cohort, right? Are you comparing to like C3 AI and some of the other smaller companies that are kind of more in their infancy, or?
Yes, C3 AI will skew the results a lot because it's over 50% for them. But they are included, yeah. I tried to weigh it by... it's hard to weigh by market cap because some of these are tiny. But yeah, Datadog, Salesforce, ServiceNow, Snowflake, C3 AI, and a bunch of like different SaaS businesses, basically.
The reason why I ask is because if we want to be rated and valued like the big boys at 250 billion, like Cisco and Salesforce and the like, then share-based compensation should reflect that and not reflect that of what C3 AI is. And I recognize that part of that is skewed due to the fact that we are early in the journey and still have low revenues comparatively to those companies. But the goal should be to eventually get to that point. And I anticipate that is the point, and where we will eventually get towards an asymptote of where we land with respect to share-based compensation. But my hope is that I'm okay if they, issue at the moment 20% and it drops to 15 over the next few years. But having $5 billion on the balance sheet with not doing anything with it is what's bothering me. And I know, I bang it to death, but I'd be curious to see if they up their, what was it, $20 million of share buybacks this quarter, or 64 for the entirety of the year, if they grow that closer to 150 million. Because if you think about it, that was 6% of the entire ops cash that they generated throughout the entire year, assuming they generated about $1 billion. I think that's about where we ended up for the year. So if that's the case, we only bought back 6% of what we generated. To me, that's a low number. And with low capex, like 1 to 2%, I think is what our capex value is. That means we have only really spent 8% of what we brought in terms of cash. I recognize that we're still in a place where, with respect to SBC and what happened with the SARS, if we were, I guess, a little bit more aggressive with spending our cash, we might not have been able to be to a point where we were GAAP profitable this quarter, because we wouldn't have had the interest income to potentially offset some of it. But either way, I'm looking forward to, as the company matures, as it gets to 5 billion, 6 billion in revenue, and that 1 billion in ops cash per annum turns into 1.5 to 2 billion. Really, where are they going to deploy that? Because you can't just dilute shareholders to kingdom come, right? I mean, you diluted shareholders by over 7% in the last 12 months. Meanwhile, you're just stacking cash and being able to sell shares. It kind of doesn't have the best look. Granted, I'm giving them grace, right? Because it's only been 4 years since they direct listed. But if they want to be treated like the big boys, $250 billion market cap and beyond, and get that sort of valuation, they need to treat the shareholders that way.